Hello everyone. We wanted to give some examples or show some examples of some of the, I might say, more difficult or easy to forget provisions in Chapter 7 having to do with capital gains and those types of property sales of transactions. So we've got a machine. Now, we're going to do this machine and building both as if they were used in the business for more than 1 year. That means that they qualify for, you might say, Section 1231, at least for the machine, treatment, which means if it's sold for a gain, it is capital. If it's sold for a loss, it is ordinary income and gets to offset your other business income. So, for instance, our machine, the current book value is $21,000. So, if we sold it for $19,000, we would have a $2,000 ordinary loss. That would be used to offset other income from this business. However, what if we sold it for $24,000? Now we have $3,000 gain, and at first blush we would think this is a capital gain which has the lower tax rates. However, according to depreciation recapture, right, which is section 1245 of the Internal Revenue Code, it says that this is ordinary income. So up to the amount of the depreciation. So we would have to sell it for $86,000 to get a $1,000 capital gain, because now we're selling it, our gain is more than the depreciation. So until we have to recapture all the depreciation we took, and then it's capital gain. So even though Section 1231 has that provision, if you use it for at least a year, that you have that special treatment, it doesn't apply when there's depreciation involved, at least if the gain is up to the amount of the depreciation, and that is almost all this case. I can't imagine a situation where you would have a machine you used in business that you would have bought for $85,000, depreciated several years, and have it be worth more than what you bought it for. That seems quite unlikely. So, but that's how the rules apply. For the building, our building in this example has a book value of $390,000. So now, much more likely to sell a building for more than what you originally paid for. Now, because buildings are considered Section 1250 property, the rules are a little different. So let's say that we sold it for $800,000 after we depreciated it. So we still have sort of depreciation recapture, but what we don't really call it depreciation recapture. Well, it is Section 1250 gain. So the amount up to the amount of the depreciation is $160,000. So we sold it for $800,000. The book value is $390,000. So our total gain is $410,000. $260,000, or the amount of the depreciation, is Section 1250 gain. Now, the maximum rate on that is 25%, not capital gains rate, but it's 20%. So it's still a better deal because it is not as high as the regular tax rate, but it's still not as low as the capital gain rate. Now you'll never pay more than if this you would pay on at your rate if your tax bracket was lower than the 25%. And then the rest is section 1231, which remember tells us that this we can have capital gain on the amount that you're over what you originally paid for. So the other 150,000, remember we said the whole gain was 410. So in this case, section 1250 is 260,000 capital gain with the special tax rates. Well, this has special tax rate too, 25%, and then this truly special tax rate of 20% maximum for capital gains for 150,000. So that together, those are 410. Okay, so that is how you would build that through. Now, moving over to an investment scenario where we have several investments. This individual has lots of different stocks and various other investments that they have bought and sold during the year. And we summarize them at the end of the year to do their tax return and look at the tax situation. We put all the things in the tax that were short term, less than a year, capital gains, ended up with a gain in one bucket, and that's 6,000. And then all those that were sold at a loss, less than 1 year, in another bucket, 4,000. And then the long term, 7 and 15, vice versa, this more than 1 year. So we have our 4 buckets. Now the first thing we do is we offset the short term against short term. So what we have is the net capital gain of 2,000. Which is short term. And then we offset or work together with the long term. So we use short term against short term, and this is an $8,000 loss, right? So now we have a net capital loss, net long term of 8,000, net short term of 2,000. Now, just as a reminder, anything carried over from the previous year retains its same character. So it was a short-term loss and you couldn't use it, you carry it over to the next year with the same characteristics. So in this case, what we would do is, now that we're done netting against the short-term and long-term, is we net the short-term against the long-term. And in this case, we're going to have a $6,000 overall loss, right? Because the loss long term is 8,000, short term gain is 2,000. So when we offset that, you're going to have a loss of 6,000. Now, what were you going to do with that 6,000? You'd be able to deduct 3,000 of that in the current year. The other 3,000 would have to go forward to the next year. That would be, in the next year, a long term. Because what did we end up with? We ended up with more long term than short term. So this is a long term capital loss. And so it will go forward with 3,000 to the next year and be a long-term loss there as well. Now let's say we change this a little bit and we make that the long-term capital losses 8,000. All right, so now our net capital loss is only 1. So now, when we net our short term against long term, we actually end up with a gain, and the gain is short term because the short term part was higher. So this was $1,000 gain on the short-term side. And so that would be taxed as ordinary income because it's short-term, less than a year, and because you've netted already, then you actually would just count that as income just like any other income, not use the capital gains tax rates on that. And that doesn't happen. You don't know that that's the case until you've done all your netting together.